my next question, now here's the learning portion, is so coming from me, just doing commercial loans as well, the obviously owner operator, brokering to banks, those are kind of an SBA or something that I've already kind of gotten accustomed to. Now, the equity portion, I want to see maybe if we can all learn, because I know there's people in our audience that are even real estate agents and brokers that aren't familiar with going up higher in the capital stack, what a capital stack means, what are the terms being thrown around, that's preferred equity or senior debt or mezzanine. So if you could kind of, you don't have to go so much in detail, but just kind of a lay of the land for everyone on what that means to go up into equity.
Sure, happy to. So, let me back up. And, for those that don't know me and George Smith,
yeah, please.
I can talk just briefly about the company and then kind of what we do. So
yeah.
We're debt and equity finance brokers. So we focus on the finance side of real estate only. So we don't do investment sales or leasing. We're pretty pure in our focus. And the company does about $3 billion a year in production. I work, as you said, as a member of the Davies Group together with Malcolm Davies, and we have the biggest team in the shop and have been the biggest producing team in the shop last couple of years. So we're proud about that. Our focus is really helping entrepreneurial sponsors get their institutional level deals capitalized. So we focus on middle market sponsors, let's say, that tend to be doing large deals. I would say the average deal that we work on is probably $40 to $50 million, and we can dip down as low as 10 million. And last year we closed the biggest deal in our firm's history. It was a $600 million deal
wow.
for a ground up high rise that in downtown Portland that included a Ritz-Carlton hotel, residences, and office space.
Congrats on that deal.
We're proud of that. That was pretty momentous.
Yeah.
The reason I preface with all that is our sponsors tend to have needs that are both on the debt side and on the equity side of the capital stack, and we spend time in both. On the debt side, most of them are focused on non-recourse financings.
Right.
And not always, but a lot of the times they want to get high leverage situations because they have syndicated equity in their deal.
Right.
They have a family office equity partner in their deal that will allow them to utilize leverage, maybe unlike a traditional private equity fund equity source out there that might, sort of cap your leverage at 60 or at 65%. So oftentimes they'll call us up and they'll say, hey, we need you to find high leverage financing. So what are our options? So backing up, prior to COVID, you had a lot of what we called stretch senior lenders that were out in the marketplace. And those were essentially debt funds that were offer non-recourse, construction and bridge executions that were pretty high leverage. You could, before COVID, get, up to 80, 85%, sometimes even 90% loan to cost on large deals, non-recourse. And look, those last dollars get expensive because as lenders get higher in a capital stack, the debt begins to feel more like equity. So you pay for it. But, look, if you look at playing an equity debt provider, 9, 10% plus or minus versus what the equity is going to cost you, especially after its upside participation, there are reasons to do that. Today, a lot of those stretched senior providers are still on the sidelines, and we've gone back to a more traditional high leverage structure when we get guys that need leverage, which is basically a lower leverage senior bank loan, and then or a preferred equity provider on top of that. And so we actually put a deal into application in downtown LA. It's about $100 million deal and needed about $75 million of construction debt. And so we asked about a $50 million senior loan and a $25 million really preferred equity piece or mezzanine loan. We tend to use the term somewhat interchangeably. They're not exactly the same, but they're close. Get to the borrower's last dollar need of $75 million. And that's a 235 unit ground up multifamily deal. And look, I think that's significant for two reasons. One, construction deals are still getting done. And two, you can still find, fairly aggressive leverage. You're not finding the 85 and 90% that you found pre-COVID, but you are getting up to 75%. And on some other deals, we've even seen leverage getting pushed to 80% within the multifamily space. So that's still out there. So, when we talk about kind of mezzanine and preferred equity, we're talking about sort of high leverage debt. That's debt with a fixed coupon. In the case of mezzanine financing, it's actually, on title and, secured by a pledge of the equity and a UCC filing. Technical, if you're talking about preferred equity, you're actually in the operating agreement. But both are junior to the senior loan and both are senior to the equity. So it kind of fits into a wedge in the middle of the stack. That is very different than common equity.
Yeah.
Common equity or traditional joint venture equity, doesn't have a debt-like position,
No.
and is really sort of riding, generally, alongside general partner, alongside the sponsor. It may get a preferred return before the sponsor gets into its promote, but it doesn't get a fixed return the way debt does, and it does participate in the upside in a way that debt usually doesn't.
Right.
So I would say those are the kind of the key differentiators between kind of subordinate financing and equity that's out there. Just go on quickly, I'd say that, when we do spend time in the equity markets, pure equity markets, we work on a lot of opportunity zone equity deals, since those are still getting done today. And they're
funds, right?
Capital. The funds. And then we still continue to do traditional limited partner equity, which is tougher today, and a lot more selective and very focused on recapitalizations and distressed opportunities. And then we're still active in the co-GP equity space, which is a space where if a developer needs capital injected into its GP, or maybe a developer needs a balance sheet to help credit enhance its loan.
Happens more frequently than you think.
A lot of guys need it. A lot of guys need it.
Yeah.
Kind of helpful in pairing up groups like that. So, because so much of our work is transitional, and because we're working with transitional sponsors that are doing large deals, those are often the needs. So those are the areas that we try and focus on.
Got it.